Hi class, today we will be lecturing on Chapter 2, Recording Business Transactions, and we are actually going to be looking at Learning Objective number 2. Okay, so let me get to that slide. Okay, here it is. So we're going to define debits, credits, and normal account balances using double entry accounting and T accounts. So what is double entry accounting? Transactions always involved at least two accounts. Okay, so it will always involve at least two accounts. You'll have one debit, one credit, at least, and they must equal. Okay, let me change the font. Okay, so accounting uses the double entry system to record the dual effects of each transaction. So for example, if we have office supplies and we purchase them for cash, requiring an increase in office supplies and a decrease in cash. So that would be your two accounts. Okay, both of those are assets. Remember from Chapter 1, the definition of an asset is an economic resource that will benefit the future. Well, office supplies is an asset as well as cash. Office supplies is going up and cash is going down. Okay. So we use what's called a T account to represent the general ledger. It's a shortened form of the ledger, okay, and it's shaped like a T. So on the top of that T account, you have the account name. So this is the cash T account. Okay, let's see. Okay, the left side of the T account is called the debit, and the right side of the T account is called the credit. Just keep that down. Okay, everyone see that? That's the only thing that you should associate with the words debit and credit. Okay, the left side is the debit and the right side is the credit. Okay, next, how we record increases and decreases to an account is determined by the account type. So you have assets, remember the accounting equation, you have assets equals liabilities plus equity. To record an increase to any asset account, we're going to put that number on the left or the debit side. Okay, if any asset goes down, we're going to put that number on the right side of that T account, or we're going to credit that account. And then everything on the right side of the equals for liabilities and equity, the rules of debit and credit are reversed. So when a liability goes up, we put that dollar amount on the right side or the credit side. When the liability goes down, we put it on the debit side. And the same rules of debit and credit apply for equity. If equity increases, we put that on the right side, the credit side. If equity decreases, we put that number on the left side or the debit side. These are the rules of debit and credit. You have to know these rules to be successful for the rest of this course. You have to understand them. You have to memorize them. Okay, these are very, very important. Let's see if we can do this one. Okay, let me see. All right, to increase the cash account, a business would record a debit to cash. Okay, because cash is an asset, and the way we show an increase in any asset account is on the left side or the debit side of the T. So to increase the cash account, a business would record a debit to cash. To decrease the cash account, a business would record a credit to cash. Okay. This is the expanded accounting equation. So let's go over the rules of debit and credit for this one, for the expanded accounting equation. So this is how we're going to, from this point forward, this is how we're going to record transactions. You can still make sense of the accounting equation and make sure that the accounting equation stays balanced. But when we read over these transactions and all of the homework from this point forward, instead of entering that information into the accounting equation, we're going to prepare what's called a journal entry by using the rules of debit and credit. So assets, we went over that one, liabilities, and equity. Look under equity. We have our two components, contributed capital and retained earnings. Our best example of contributed capital was common stock. And remember from chapter 1, the three types of accounts that affect retained earnings: dividends, revenues, and expenses. So dividends, the way we show a increase in dividends is we put that number on the debit side or the left side, okay? Decreases go on the credit side. Revenues, increases go on the credit, decreases on the debit. And expenses, increases on the debit side and decreases on the credit side. All right. All right, the next slide. All right, the normal balance of an account. All accounts are summarized on one side of the T account, called the normal balance. So an account's normal balance appears on the increase side of the account. Okay, so assets increase with a debit. Okay, so the normal balance is a debit. Liabilities and equity increase with a credit, so the normal balance is a credit. Okay, so the normal balance is just how we show the increase to that account. It's how we show an increase to that account. Here's a chart of the rules of debit and credit. This is also in your book. It summarizes all of the main account types, how you show an increase to that account and a decrease, and what the normal balance is. Okay. And that was that slide there. That is also shown in the textbook. Another easy way to remember the rules of debit and credit, the textbook uses this sentence: all elephants do love rowdy children. The first three words in the sentence will help you remember. Assets is for A, all. Expenses is E, or elephants. And D for dividends, or do. Okay, so assets, expenses, and dividends all have the normal balance of a debit. You guys see that right there. Let me get my pen. Right there. Okay, the normal balance is a debit. Assets, expenses, and dividends. When they go up, you debit that account. Okay, when they go down, you credit the account. Love, rowdy children, L, R, and C, that's liabilities, revenues, and common stock. Okay, so when they increase, the normal balance is a credit. Okay, see that? The normal balance is a credit when they go up. When assets, expenses, and dividends go up, the normal balance was a debit. Okay? All right, the next slide, determining the balance of a T account. It says use the T account to determine the ending balance in an account. The ending balance is shown on the side with the larger number. So cash, that is an asset account, okay? And so the normal balance should be a debit because that's where we show increases. So we have $35,500 on the debit side. And on the credit side, which represents decreases, we have $23,200. So my ending balance is $12,300. And notice it shows up on the normal balance side, the side where we have the most money, okay? And that represents increases to the account. All right, let's go over now learning how to record these transactions in the format of a journal entry. All right, so let's fill in these blanks in the slide. Accountants use what's called source documents, if I can spell. They use source documents to provide evidence and data for recording transactions. These documents help businesses determine how to record the transactions. These source documents could be a check, could be an invoice, it could be a receipt, okay? It could be a loan document. Anything that is going to provide us information to help the accountant, analyze the transaction and put it into a journal entry, okay? So the next slide is going to give us examples of source documents. So we've got, there's a loan. Okay, that first document is a loan. This one, looks like it's for deposit only. That may be a check. We're going to look at that transaction and we're going to analyze it in order to prepare a journal entry. Okay, so that's the flow of accounting data. The transaction occurs, source documents are prepared, accountants analyze the information, and then we put it into a journal entry. So again, this is the flow of accounting data right here. Okay, so right here, what are 3 types of source documents? Well, we could have a purchase invoice where we've purchased something. Maybe we've purchased inventory or office supplies. Another source document would be bank checks. Maybe we wrote a check. That would be a source document. Tells us how much money came out of our checking account. And sales invoice. Maybe we've sold something to a customer. We need to record that sale. That is a source document. All right, so that just gives you an example of different types of source documents. All right, journalizing and posting transactions. So after reviewing the source documents, accountants record the transactions. So transactions are recorded in what is called a journal. That's a record of the transactions in order of the date. They're in chronological order. Okay, so the data from the journal is then transferred to the ledger, and this is a process called posting. You may have heard that term before. Okay, it's posting, copying that information from the journal to the ledger. Okay, so the T accounts right here, we've got 2. We've got the cash and the common stock T account. The T accounts represent the ledger. Copying the information over from the journal to the ledger, again, that term is called posting. Okay, the journal entry is November 1st. We received $30,000 cash in exchange for issuing common stock. So that's the journal entry. Notice you have the date. Here you have the account name, cash, common stock, and then debit or credit. We will continue going through examples in a later video.